All right, well, let's just go ahead and make sure we got sound and video and you guys can see the screen and hear me and all that good stuff, and just start working our way through this in the right direction. How you doing, Bear? You still out in the Northwest? Well, hopefully it's not too hot up there. We were hitting the hundreds for a little bit here, and then we got a nice little wave, cooled us off. Hits Kansas, so you know the saying, if you don't like the weather, just wait 5 minutes. It'll change. $108. Man. All right, so this class is class number 5. I had a surgery a while back, so I was not here for class number 3. It goes 1, 2, 4, 5. There is no 3. You can find these videos if you go to the Bullish Bears YouTube. You can see Introduction to Options Part 1. And then from there, we just start working our way down. It seems like there already is an intro to 5. I don't know. Here's 4. So there's a 1, 2, 4, 5. I think this might have been a rename or a mislabel, but either way, when you search for Introduction to Options, you'll find it. They should match the book. I have shared the book here in the chat, and then I also shared the book in the resource. So if you go to the Discord and you look for books, you will find that there is a resource. I didn't want a lot of books in there, so the idea is that I just keep using the same book. All right, so Trading Books, Introduction to Options, Part 5. It continues on from last week. So let's go to the book. Last week, we focused on expected move, implied volatility, measuring a market in the risk graph, understanding how to measure your trade. So this week, I thought it would be a good idea to start thinking about the different kind of options strategies out there, the different way that options are traded. And I kind of approached this as a new trader from the idea that we're always talking about what the big firms are doing, prop firms and these institutional traders, but I couldn't see them. I would look at the options chain and I'd wonder, well, where are they? What are they doing? What kind of trade are they doing? And then I'd see this large volume come through, and is it buying volume? Is it selling volume? Is it connected to something that they already owned? Are they hedging something, getting out of a hedge, getting into a hedge? Just looking in the options and looking at that flow didn't give me enough information about, well, what are they doing? So I went out and started looking to see what kind of options styles there are out there and the strategies that go with those styles. And I came across 2 really quickly in my research: index arbitrage and mean reversion strategies. The most common thought product when it comes to mean reversion is like the VIX, right? It always goes back to the floor, and the floor is somewhere around $10. And it always does that. It doesn't matter how violent the VIX gets, it always eventually goes back to the floor, back to its mean. But that's not the only mean reversion product out there, and a lot of products mean revert, including sectors and indexes, SPY, QQQ, IWM, XLF, XLK. Those are mean reverting products. They keep coming back to the center of their average. And the easiest way to kind of visualize that is to put a band indicator on your price action, something like a Bollinger Band or a Keltner, maybe some kind of price channel. You'll notice it goes from high to low, high to low, high to low. It doesn't matter if it's a bullish market running or a bearish market running, it still has highs and lows because it's like a pendulum going from high to low, high to low, high to low, and it keeps crossing the middle, the mean. Now, index arbitrage is something that when I first heard about it, it seemed very complex. And there's not a lot of arbitrage now compared to what there used to be because we share information so fast. The old style of arbitrage would be this idea that, for an example, Apple moves very fast because of news. And we know that since the news was really bad and Apple's really big, that when it falls, it's going to drag down a lot of different stuff. And we would index arbitrage because of it. We'd see that move in Apple and we would go short the Qs, right? And the idea would be that the Qs are going to get caught up with Apple eventually, and that Apple's going to cause the Qs to move. And they've got algorithms out that are just constantly looking for the slightest deviation in price between multiple products. And when something gets out of line, it hammers it right back into place again. We're not fast enough to be able to compete with that kind of product. So that kind of arbitrage really isn't around anymore. But there still is the other kind of arbitrage, and it's more of a concept or a theory. It's the idea that if we analyze the S&P, and we could use that analysis to take a trade in Apple because they're connected. And if we see that the overall marketplace represented in SPY is bullish, then 3 out of 4 companies are going to be bullish. And we could pair that with a bullish sector in a bullish index and then pick companies in that sector that go to that index, right? And it would be looking at a particular product like the Qs or SPY and then trading something out of that basket. So index arbitrage does not have to be as complicated as the old material will make you believe. And you really just, if you go searching for that on the web, you're going to find a lot of antiquated stuff that really doesn't apply anymore. So be careful with that one if you go searching for it. There's another kind of trading out there that focuses on delta trading. I run over 200 trades at any one time. I've got 10 accounts, or excuse me, 10 brokers, multiple accounts more than that, and I've got a lot of trades. I can't go in and stare down every single trade every day. I need to have an overall aggregate understanding of my entire risk right now in the market. If SPY falls $5 this week, what's it going to do to my account? That's what I really need to know. And I can do that by beta weighing my portfolio and looking at my aggregate delta values. And when your delta trading strategies come into play is maybe I'm long, 175 delta and I'm feeling a little bit of risk and I want to reduce that risk. I want to get rid of some of my delta. Well, I don't necessarily need to close down a trade. Maybe I just need to open some short trades and I will find some negative delta there and decrease my delta value. Gamma trading is the day trader's dream if you can recognize its value and target it effectively. It's the wrong day of the week to be looking for a high gamma value, but I ran the scan anyways. GNW right now has a high gamma. This is something that you normally find later in the week or on one of the products that have 3 expirations in a week. Notice the gamma right here in GNW for the $4 strike has a $1.54 gamma and a $50 delta, or 50-cent delta. It's 3 times larger than the delta value. And this $7 option right here, if we were to buy it, would gain like 750, almost 800% in a 50-cent move in the market. That's the beauty of trading a high gamma strike. All right. And used efficiently, this can be a powerful, powerful way to trade. And it's almost an all or nothing trade, right? You buy this for $7, and if it loses, so what? It's $7, you know? But if it wins, you could hit $70. Well, I will risk 7 to make 70 any day of the week, right? And you can lose in a trade like this 3, 4, 5 times in a row. But then when you hit it, you're knocking it out of the ballpark, right? So gamma trading focuses on a high or an elevated gamma value. Now you look at this $1.54 gamma, and then you go look at something like SPY with a, I don't know, like a 6 gamma. Oh, a 14. There you go. Yay. A 14 gamma, right? When you add that up and you see the move, not a lot of love there, right? I did do videos on the Greeks. They're on the Next Level library. You're going to really want to see how those Greeks come into play, but we're not going to dig down into those Greeks today. So after the gamma trading, we have probability-based trading. And this has always been one of my favorites. I'm a little bit biased on this. I like it. I started doing these first because I didn't have any skill at technical analysis. I had a day job. I couldn't watch the market. Other than lunchtime, I really couldn't even look at charts. I could see my P&L, and that was about all. So I needed a way to be able to trade that did not rely on technical analysis because, 1, I didn't have any skill at it, and 2, I didn't have the time to do it. Probability-based trades relies on the math. You don't need a chart. You can look at a chart at the end of everything that you're doing and maybe try to, get a little more confirmation of what it is that you're doing. But at the end of the day, no chart required. And that's a great benefit when you're new to trading and you don't have any skill at reading a chart. Any questions so far? Well, the easiest way would be to look up and down the strike, right? Just like we normally do, the strike price shift differential. So if we go back to GNW, what will I make if this option moves to the next strike? If I bought it for $7 and I can sell it for 70, 71, split the mid here. Let's turn the mark on, and that'll make it a little easier to do the math. So if I buy that option for $7, I could sell it for about 60 if I'm right, and I will lose all of my $7 if I'm wrong. Very simple calculation. Look up the chain, look down the chain. If we move 50 cents, this will change strikes, and the gamma will be applied to the delta, and the change comes. So what I bought for $7, I will be able to sell for 60. And if I'm totally wrong and we don't make that rally, what I bought for $7, I can try to buy back for half of a penny, meaning I'm going to lose all my money. Strike price shift differential is the easiest way to day trade options and understand your risk values. It always has been, it always will be. Now you can stick it over into the Analyze tab and try to do all that kind of funky stuff, but a lot of the time, we don't have the time, right? When we're trying to day trade, we got to get that thing done. So we don't want to take it and kick it over to the Analyze tab and move the slider up and down. And then they also have a profit calculator. So you can go into Customize and type in Pro. Bring up the prop. No, I didn't. I see a Theo. Theoretical pricing calculator. Where is that thing at? Theo price. At that way. So you can bring that up and then click on it up here. And you can adjust the stock price. So we're at $4 now. What if we went up 50 more cents? That would give us a resulting price of $4.50. And now it's giving us an option price. What would this option be worth if we rallied 50 cents? And it's showing right here. Now, which one of these is more accurate? The one that's 60 cents or the one that's 50 cents? I'd say the one that's 60 cents because it's also taking into account a lot of other factors, implied volatility, theta decay, all the other things are in there. This Theo calculator left it up to me to change the volatility, and I didn't change it. So it's also trying to calculate end of day values because we can go in and change our values, right? So the calculator is okay, especially like in a swing trade, maybe, but I never really liked it. It seems kind of bulky and cumbersome, and you always have to remember to hit the reset button or you can really jack stuff up. So it's the easiest way is just to go in and look up and down the strike, and it's called strike price shift differential, which is just a big old mouthful of saying look up one and look down one. All right, so on Thinkorswim, trying to beta away your portfolio can get a little complicated. You have to go into the Analyze tab, and then you have to set it up. You have to turn some things off and turn other things on, and then pick your beta product. And if you don't set it up right, it looks all kinds of confusing. If you go to Tastyworks on the web, it will immediately beta away your portfolio for you, which is really nice. You can just go over there and look at it. But you have to be careful of what it's doing because it's literally doing your entire account. And if you've got odd things in there, it's going to read them oddly, right? So you're going to want to go in and turn things off that don't belong or that might not fit into a delta scenario. For example, if I buy a call for January and then I sell a call against it for September in the same strike, they're taking care of each other, right? Their delta is not exactly the same. And yes, there is some risk in there, but they're already dealing with each other and they're pretty much canceling each other out delta wise to a point, right? There's a little asterisk in that. But if I didn't turn those off and the broker tried to read both of those trades, it could skew all kinds of perception of risk, right? So when it comes to beta weighing your portfolio, we'd almost have to do like a couple of classes on beta weighing on its own. But just for an example, we're going to go in and we're going to beta weigh whatever I have in this account right now. And I got some odd junk in there. So for all groups, no, we don't want all groups. Let's see, single symbol, no, we want beta weigh. And now that I've turned it on to beta weigh, it's asking, well, what symbol do you want to use? I'm going to use SPY. Then we can go in here and we can tell it to hide simulations. And what that basically is doing is every single trade that I've ever built, if I haven't gone in and deleted it, if I built it, it's now down here, right? And there is going to be all kinds of junk that I might have looked at in the Analyze tab, but I never really put on. And like this Tesla butterfly that we were looking at earlier, I built it, I was looking at it, it's now down here. I got to get rid of it because it's trying to bait away all that stuff. So now that I've gotten rid of all that, if I tell this to hide simulations just to make sure, we look at the top up here, it's not showing. So something's wrong. Well, I know that I've got a diagonal in GE. I've got a diagonal in American Airlines. And I don't even think I have a SPY trade on anymore. Thought I got rid of that. Let's just see. Yeah, I don't have a SPY trade on. Why is SPY showing up in there? And this is why it sucks to try to bait away on Thinkorswim. You have to go in and try to turn off anything that might be complicating your beta weight. And sometimes you don't know what it is, and you have to go in and literally turn everything off and then turn it on one at a time. So right now in my account, this is my current aggravation of beta weight, and something is still off in there somewhere. But we got a really good idea, probably that XRT trade, of what kind of risk I'm holding in this account. If the market was to move, meaning SPY, if the market was to fall below 358, I'm going to start gaining in profit. Right now, I'm sitting in this valley of limbo. And if we stay there, I'm just going to lose more and more money. But if we move to the upside far enough, I'll see profit. And or if we move to the downside far enough, I'll see profit. This is a way to aggregate your entire risk so that you can ask the question, well, how much am I going to get hurt if SPY rallies $70 in the next 3 months? And we can go in and look at those values and try to figure out what that's going to be. This helps you try to determine how much of a hedge you may need. Or if you're getting ready to put on a new trade and you're not really married to any one particular idea, you're just on the hunt for a new trade. If you're long a lot of delta, maybe you want to find a short trade to put on that you know you really don't need another long, you've got enough longs. Or if you're already short a lot of delta, that you could go in and try to get a long trade somewhere, deliberately looking for a long position rather than a short one, knowing that you're already short a lot of beta. So that's another way that you can approach trading when it comes to options, these different strategy styles. That there are a lot of reasons to want to go into trade, and hopefully this stands out on the on why it's so hard to try to figure out what the firms are doing, right? Because we've just barely scratched the surface of the different styles that are out there, and they can be doing very complicated stuff that involves multiple products, some going long, some going short, hedged and paired and arbitraged. And then we'll see them go in and like sell 1,000 options in, I don't know, Tesla, and we think, oh wow, look, they're bearish, they're selling calls in Tesla. No, they might not be bearish at all. They might be hedging something and we don't even know, because those other trades are already on and they've been holding them for days or weeks, right? So it makes it hard to try to figure out what's going on because of those things. I took a picture here of SPY when it was trying to break out. And this breakout in the indexes is connected to these sectors. These are driving this in the market, right? This move up is coming from the stocks that are in these sectors, and these sectors combined are driving this index higher. This would be a form of index arbitrage, that perhaps we evaluate the cues and then we look at the sectors and we decide that we're bullish in the market, and then we would go out and find things to trade because of this index. You may have never put the 2 and 2 together, but that's index arbitrage, that you're using a particular index or a sector. Index is kind of a funny word. It basically just means basket of. So if you build your own basket, you've built your own index. And on Thinkorswim, you can do that, which is kind of cool. But you can use that basket as an aggregate, and then from that evaluation, find things to trade. And a lot of places trade this way. Heck, I trade this way. I go in and look at what's going on in the SPY. I evaluate what's going on in the overall market. And from that evaluation, I try and determine what trades I want to put on next. Am I going to go heavier in energy and maybe lighten up in the financials because of the bond moves, right? That we can evaluate one thing and then go trade another thing because of that evaluation. Index arbitrage in its most basic form. Probability-based trading, I think, is going to be something that most new traders are going to struggle with unless you've got math behind you. And I say that because when I came into the marketplace, I have an engineering degree, I have a Microsoft degree, and I have a psychology degree that dealt with statistical mathematics. So when it comes to math, I'm a little bit of a nerd. I already understood a lot of the complex formulas they were throwing at me. There are so many things in the market that use standard deviation and bell curve statistics and measured moves, linear regression, and dot plot. And so once you grasp those concepts, your ability to trade effectively is going to expand exponentially. You'll become a better trader once you understand those logics. And they're the easiest thing to trade. We talk about it often here, that instead of trying to figure out where SPY is going to be at the end of the week, all we have to do is try to figure out where it won't be at the end of the week, right? And that's so much easier to do. Sitting here looking at a SPY chart on the daily, you can see that we are right back up to the top of the range again. And if we were to look at this on, I don't know, a 28-day scenario, how likely is it that SPY will be below 410 next month on the 20th, or in the third Thursday of the month next month? Pretty unlikely. I mean, it's possible, right? But it's a low probability that it's going to be below 410. Well, how about 400? Really low probability, right? I mean, it can do it, but damn, we would need one a hell of a move in the market, right? So that's probability-based trading. How probable is it that SPY will move lower than $400? And then we trade based on that probability. The only problem with probability-based trading is that a lot of people don't quite understand it. And they approach it from the idea that, well, I want to win all the time. Yeah, I get it. I want to win all the time too, right? But if you build a trade that has a 99.9% chance of winning, you're not going to make any money because you didn't risk anything. And it's a very fair and very balanced marketplace. If you don't take any risk, why the hell should you get any reward, right? The other person should get the reward. The person who did take all the risk, the person on the other side of your trade. So we are constantly trying to balance that teeter-totter between risk and reward. This idea that we have to have risk and that there has to be something out there that we can trade, and it has to match just the right amount of risk for the right amount of reward for your account. And unfortunately, this isn't something that somebody else can tell you, right? Nobody else should be telling you how much you can stomach in a trade. You have to be able to sleep at night. Someone with a $50,000 account will be able to stomach a lot more risk than someone with a $500 account, right? So you're absolutely the master of that domain, and you are the one who needs to find the balance between these two scales. How much risk are you taking versus how much reward you're expecting to get? But due to the fact that options are probability-based products, you literally can define exactly how much probability you want every single time, which means you can target a probability consistently. If you want to trade something with a 65% probability all the time, you can do that. And that's really cool. Maybe it's just because I'm a nerd, but I think it's cool. Questions so far? Yay, the NASDAQ breaking into all new highs. I'm glad to see that because I am long in a NASDAQ trade. And I'm not really watching. I shouldn't do that. All right, so no questions. We'll move on. Mean reversion as a concept in a trade, I'm telling you, I never see posts talk about indexes when it's mean reversion. I always see them talk about the VIX. And that's okay, I guess, because from a perspective of trying to understand mean reversion, the VIX does a really good job of that, right? If we was to take something like the 5-year weekly, notice how it always comes back to the ground. It always comes back to the floor. That's mean reversion. No matter how violent, no matter how volatile, eventually it always comes back down to the ground. That's mean reversion. In its most basic form, it's mean reversion. Now, one picture that I never keep, and I really need to, is the old style grandfather clocks. This swinging metal spoon underneath this clock, it's called a pendulum. And it can only move a certain distance to the left and then a certain distance to the right. Now, occasionally it's going to swing a little too far one way, or maybe not quite far enough the other way. But at the end of it all, it always comes back to the middle, to the mean. Now, this thing moves left to right, left to right, left to right, left to right, left to right. Well, the markets move up and down, up and down, up and down, up and down. They're always mean reverting. So for those new traders that always ask, well, I see the setup, but is that a 15-minute setup, a 5-minute setup? Should I be looking at that on a 30-minute? What's a good one? Any of them. It would work on all of them because it's a mean reverting market. We will always revert back to the mean no matter what time frame you're on. A tick chart, a daily chart, a yearly chart. Doesn't matter. We're always going to come back to the mean, right? So in a downtrending market, there is a drawing tool right here, the line with the R. So the regression line. If I drew from high to low, and I just stop right there from high to low, you can see how the market expanded underneath that line, came back across, expanded above the line, came back across, went underneath the line, and then back above the line, and then back below the line. Mean reversion. It just kept swinging back and forth, back and forth, back and forth. Now that back and forth motion has been measured and quantified. It should not expand past that line X amount of distance 70% of the time. That it's going to stay inside of a channel. Notice I can redraw as a channel. So I'm going to do that. This channel defines the edges and says you should not go below this point more than 30% of the time. You should stay in this box 70% of the time. So that's good to know. And we can always do that measurement on any time frame, on any market. We can always find a regression. This is why sometimes we short a market that's running crazy to the upside, and sometimes we buy a market that's running long to the upside, right? Because we can see that it's perhaps extended, but maybe not as bad as it could get, and that there's still room for more extension to the upside, right? And then other times we see something go crazy parabolic, and we short that sucker while it's still running up because it has gone too far. Understanding linear regression and mean reversion, it's a thing. It's not going to be something you'll be able to learn quickly in life, but I promise you it's worth it. So to be able to draw that, you want to right click and get this menu. You know what? I had it right the first time, but there you go. Add a drawing and choose the one with an R. If you want the channel, you could choose the R with the 2 lines. But if you just want the line, then you can just choose the R. And when it comes to what peaks to pick, there's something that we need to discuss when we're talking about any linear regression tool on Thinkorswim. It's counting the candles that you give it, right? So where you start and where you stop might not necessarily have anything to do with the fact that we were at its highest or its lowest value. It's how many candles are between this starting point and this ending point, because it's counting every one of them. And the reason that I bring that up is because there is an indicator on Thinkorswim called linear regression, and it will do it all automatically for you. But you have to be very, very careful. If you turn on a 1-day 5-minute chart, that linear regression line will look completely different than a 5-day 5-minute chart. They're both 5-minute charts, but that linear regression line will be completely different because one is measuring 1 day of candles and one is measuring 5 days of candles. To find those tools, type in REG. You got the LinReg 100, the LinReg 50, the VAR, the curve, the trend line, and the reversal. Well, there's your trend line, right? So you just turn that on. It is now measuring every single candle in this 5-day, 5-minute chart. Use it consistently. So if you're always looking at a 5-day, 5-minute chart, that's where you want to use your linear regression. If you change for some reason and you go in and you go to a 1-day, 5-minute, you've now jacked the whole thing up. And now this, for an example, says that I'm underneath the line and I'm working my way back through it. But if we go back to that 5-day, 5-minute, I'm way, way overextended and I'm looking for a market to reverse, right? You can see how it really screws our bias up. Now, there's no wrong way to draw that linear regression. You can start at the peak and go to the valley. You can go wherever you want. You can set it on any time frame. The only rule that I would ever give you is be consistent in how you use it. There is a term, and I always forget the language that's used in this term, but it basically says, if I travel this far underneath it, I am also going to travel that far above it. And I don't remember the language. It's my fault. I just don't remember. But you can see I copied that line, moved it over here, and we're not there yet. We're close, but we're not there yet. Now, this concept that we're looking at right here, where I measured the depth of that distance away from the regression line and then marked it over here, we see the same thing when we're looking at the RSI, for an example. So with the RSI, if it goes to a 90 on one side of the RSI, it will go to the 10 on the other. Maybe not in the next move, maybe not in the next impulse, but it will go to the 10 on the other side because it hit 90 on one side. If it goes to a 15 on one side, it will go to 85 on the other side. So keep that in mind. This concept of distance in a measurement is not just in a linear regression. You can see it in all kinds of things, RSI included, MACD also. But so for an example, if you're like me and you use a 6-month daily chart, don't decide all of a sudden that you're going to use a 1-year daily chart, because it is going to jack your analysis all up. And then you're going to be misinformed, right? Because it won't match the current analysis of what you've been doing. And there is no way to get it wrong. You can literally use whatever you want. Just do it consistently. There are quite a few tools on Thinkorswim that use this logic of a linear regression in some form, and that also deals with a pullback. Anything that puts a band around price, I shouldn't say anything, but 90% of all things that will put a band around price is in some way using a standard deviation. It's telling us how far a market should move 70% of the time on the time frame that we're looking at, which is beautiful because it self-adapts. So if you're on a tick chart, say a 300 tick chart, and you're looking at a futures product and you want to take a scalp, the standard deviation is still going to show you how far that market can move 70% of the time. So when it gets to those highs, you know to short it. When it gets to those lows, you know to buy it, and that you'll be right at least 70% of the time. We can see that in things like the Bollinger Band. Literally in the language right here, deviation up and deviation down, we're using a 2 standard deviation. And you can go in there, of course, and you can load more than one Bollinger Band. So right there, I have a 1 Bollinger Band set to a 2. I can load another one, set it to a 1. And you got to change both sides, right? You change the top, you change the bottom. So now I've got a 1 standard deviation move. I got a 2 standard deviation move. Heck, we can do it again and we can load a 1.5, right? Kind of split the difference between the two. Now, a 2 standard deviation move covers 95% of all of the move. That means it's going to be right 95% of the time. The price is going to stay in that boundary 95% of the time. And when it leaves, it would be an anomaly, right? It's doing something the other 4 and a fraction of a percent of the time. The thing that it very rarely does, it's suddenly doing. So when you do see price break out of a 2 standard deviation move, that's a big deal. It's a real big deal. It means that market moved so hard and so fast that it expanded beyond its mean with a 2 standard deviation move. Back in February of last year, we saw a 7 standard deviation. That's something that they would normally use in a language very close to the word impossible. Now, in math, they don't use the word impossible. They say improbable. And before the virus hit, they would have said that a 7 sigma move is very improbable. And now they can't say that anymore because we've got one recorded in our history. So now they have to say something like, well, an 8 or a 10 sigma. And you got to think about it. If a 2 sigma is 95% and a 3 sigma is 99.9%, what the heck is a 10 sigma move? Right? Like a 99.9999999% chance that it would never go there. And we went there. So using any indicator that has a standard deviation in it can visually aid you in the idea of how far have we moved and, quote, is it far enough? Have we expanded beyond the edges of the deviation, the edge of the boundary? And of course, you're always going to want to know how far back is it looking? Is it looking at every single candle on the screen, or is it counting back so many candles? The Bollinger Band defaults at 20 candles. Oddly enough, that's also the middle line, which is a moving average, right? It's a 20-period moving average on a daily chart. Which moving average? The simple moving average. And you can change it to exponential. Now, if you do that, however, it's going to be weighing on the front of your standard deviation as well, because an exponential looks at the closer candles than the farther out candles and weighs them a little differently. So it's going to be a little more complicated to wrap your head around, but it would still work, right? And now that I changed it to exponential, look how ugly that Bollinger Band got suddenly. Really just nasty stuff, right? When you take it back to something more elegant, simple, uniformed, clean, standard deviation. There are so many ways to trade probability-based trades, and using any kind of cone of probability or implied volatility, historical volatility, all of those are using a probability-based trade style. Anything that calculates pop is using a probability-based style. So you got probability of touch, you've got probability of being profitable. All of those use that same style of formula, a standard deviation, a bell curve, and it is asking the question, how far should a market move before it's reached the edges of that standard deviation? And we can trade that, right? We can trade on the idea that it's going to stay inside of it, or we can trade on the idea that it is going to break out of it. And of course, if we are on the side that has a very, very high chance of winning, we won't make very much money. And if we're on the outside, then we have a chance to make a whole lot of money. So we got a question here from Trader. Can we draw a linear regression line on BMY and then compare it to the, I'm not sure what BB is, to the company BB? So you would need to normalize things, right? If we first just start with a BMY, what time frame would we be using, right? If we're going to draw a linear regression line, where are we going to draw it? The daily, the 15, the 1 hour? And then are we going to draw it across every single candle on the screen, or are we going to randomly pick our own candles? Those would be some of the questions we would need answered before we can even do that. And then suppose we were going to look at two different companies. Here's the BB, BlackBerry, and here's BMY. If we were going to look at both of those, why would we want to compare their linear regression values? Linear regression is a mathematical formula, and it's basically looking at a number. We'll just say this number is 1268 and this number is 1274 and it's adding all those things together, and it's doing some statistical math behind it. And when it's done, it's going to have this value drawn. And that's not a regression line. I just drew a line. It's going to have this line drawn based on called a dot plot statistic. Each dot was developed because of every single candle, and then it connected the dots all the way across the screen. It would only apply to that one single market on that one single time frame for as many candles as you marked. And if that market went up or down, it wouldn't be connected to some other market unless they're arbitraged in some way, right? Like peers. If Caterpillar goes up, you would think John Deere's probably going to go up, right? And if Caterpillar goes down, John Deere's probably going to go down as a peer group. But if Caterpillar gets bad news, Caterpillar might go down and John Deere might go up, right? And then we got an arbitrage opportunity. So comparing linear regression lines to different markets would only make sense if those markets are connected in some way. And if I lost you along the way, the one thing that I would recommend is start to learn how linear regression is mathematically calculated. Begin to look at math classes that are free on YouTube that will teach you about statistical mathematics, bell curves, and all of that. So I've got BMY up, and we're looking at the Bollinger Bands here. And we can also go and look at BB. Now, the reason that BB moves or doesn't move apparently has nothing compared to each other. So I'm not gonna continue to do this, but your chat right here, this is you and me chatting together and nobody else can see it. Take this chat here and bring it back over to the Discord where everybody is participating, right? So bring that over here, because this is where we're at, right? I don't want to have to go into private chat with you and then every other Joe Schmo that wants to reach out and talk to me during a stream when we're all right here. They do seem different. And the reason why is linear regression lines are not Bollinger Bands. Bollinger Bands are showing you a 1, 2, 3, 4 standard deviation, whatever it is you set the Bollinger to. Whereas linear regression is running a mathematical calculation and is giving each candle a particular plot all the way across the chart, or however many candles you go, right? And this Bollinger Band is only counting 20 candles. If we were to draw a linear regression that only used 20 candles, would it work better? Yeah, I don't know. Count back 20 candles, snap their linear regression, and see if it matches. I wouldn't get hung up on these two ideas here, though, right? use a linear regression, use a Bollinger Band. Don't look for confirmation from one to the other, right? They're two different tools. That's like saying your hammer and screwdriver aren't agreeing with each other. Probably not. They're both great tools, but they're each going to do something different. And believe it or not, I have used a screwdriver for a hammer. It works. It doesn't work very well, but it works. So with the linear regression, it is literally counting every single thing along the way. And that Bollinger Band is not. It's only counting 20. And then what they're showing you is completely different. The bands are showing you a 2 standard deviation. The linear regression is showing you the middle. Right, but we were talking about a line, right? So let's turn this into a channel. Now, Thinkorswim's channel, when it comes to linear regression, is still going to count every single one of the candles that I've got defined here. And this is a drawing, so we'll have to go in and see what the standards are. We're using a 1 standard deviation coefficient right here. We could change it to a 2, a 3. We could redraw the thing, right? We can add more curves. And now we've got more, right? We can go in and add another curve. But these are still two different things because I don't know that I captured 20 candles. I don't. Maybe if you count back exactly 20 candles and then you mark your linear regression line and you give it a 1 standard deviation or a 2 standard or a 3 standard, and then you set your Bollinger to the same thing, and maybe they'll give you the exact same lines. But I really don't understand where you're trying to go with it other than to see if a linear regression and a Bollinger Band give you the same answer. Now with the Bollinger Band, notice I have 3 of them on here. I've got a 2, I've got a 1.5, and a 1. Well, you're talking about a statistical accuracy on a micrometer scale level, right? And we're looking at price action, which is going to drift. There's always an engineer in the group, right? There always is an engineer in the group. The only problem is you're an engineer that don't understand linear regression and dot plot to statistics. They're as accurate as you would ever need. Let's put it that way. And that since you can't even tell the difference between the two, they're as accurate as you will ever need it to be. And what's accurate? That it's supposed to move that far 70% of the time. It's going to be right 70% of the time. That's how accurate it is. Both of them. But just because it says it's going to stay inside of this range 70% of the time, it doesn't mean it's going to move up when it gets to the bottom. And it doesn't mean that it's going to go down when it gets to the top. It can get to the top and stay there. It can get to the bottom and stay there. It can get to the bottom and break out. We're on a daily chart. What's 70% of the time on a 252-day chart? That it can be wrong 30% of the time. How many days are that? Right? And that'd be the one where you go into the trade or I get into the trade and we try to go long off the lows and it keeps going lower. These tools are not new. They've been around for a long, long time. And if anything was dead perfect at drawing a high or a low, everybody in the world would use it. Everybody. We wouldn't even have a discussion of like, well, what's the best way to draw high or low? We would all go to that one thing, pick it up off the shelf and put it in our pocket, and that'd be the tool we use. And we don't have one. Nobody has one. So this isn't going to show you a high or a low any better than anything else. It's going to be accurate about 70% of the time. And then when a market leaves this boundary, that's when it gets your attention because it's doing something in the other 30. And if it moves a 2 standard deviation, it should really get your attention because now it's doing something outside of the 95. This analysis tab that we reviewed last week has your probability range right up here. That's exactly right. And you don't even want to do that, right? You would want to be the other guy. You would want to take the other side. We don't want to be right 95% of the time. I'd rather be right 5 than 95 if that was my two choices. So here's the same standard deviation. It's the same bell curve. It's the same 100%. It's the same. The only difference is the numbers for the market are on the bottom instead of on the right. If you do want them on the right, go to probability analysis, right? Now we've got the numbers, well, they're on the left, but at least they're on the side. And we've still, again, got that curve. How far up or how far down should the market move between now and the next 90 days? Well, how about in the next 50 days or in the next 20 days? We still got that standard deviation. And we can use Bollinger Bands, the cone of probability, implied volatility, Keltner channels. It's still going to come back and give us this standard deviation. A statistically significant move would have to go to the market you're looking at, right? And I know that that sounds like a crappy answer, but if you think about it, things like AMC or GameStop have become very violent lately. And so with their current level of violence, what would be statistically significant for those markets right now, as opposed to something like XLF, right? So what is statistically significant? I'd say looking at the chart that you're on, if it can breach beyond the mean, the 70%, then you're in a statistical area. And then if it matches your risk level, there's your trade. And beyond that, that's where it would have to hang up. Beyond that, it's going to have to be your trade, what you deem to be statistically significant. So on the gamma trading for you day traders, these don't come around every day. In a product that has 3 expirations in a week, SPY, QQQ, DIA, I don't think DIA's got one yet, but it will be if it ever gets liquid enough. 3 expirations in a week. They will have a higher gamma content than the ones that don't. And as we get closer to the end of the week, typically this is what I start doing on Thursdays, but I've seen it on Wednesdays, that there are products out there with a higher gamma value. And there's no promise about direction at this point, right? It's not giving you any edge that, oh, you should buy this or you should sell this. And in fact, it's on Tuesday, looking at GNW, it's a long shot that this market could even move 50 cents, right? Look at how much it had already moved on the day. It moved a dime. And in that one dime move, it had already moved 2.5% on the day. For this thing to move 50 cents, we would be looking at a massive rally in this thing, 7, 8, 9%, right? It would be statistically significant. So you're not going to get that $1.50 off the gamma 9 times out of 10. But we don't have to get the full strike. The options chains are very, very good now. The high frequency algorithms in there are running spot on. And so if we get it, 7 pennies of this move, this option is still going to change value faster than these other options because of that gamma. Now, trust me when I tell you, you don't want to hurt your head trying to calculate, well, how much am I going to get if it only moves 7 pennies? You may be able to figure it out. Maybe. But by the time you get it all figured out, the numbers would have changed and you wouldn't be able to trade it anyways. You'd have to come up with a number again. It'll move too fast. The way that I trade these high gamma plays is that late on Wednesday or early on Thursday, I run a scan for high gamma. Thinkorswim makes that really easy to do. So we come in, go to scan. You can go to Option Hacker if you want to, but really, Stock Hacker will do everything that Option Hacker will do, plus it does stock. Options Hacker will only do options, and that's all. So if you only wanted options and you never wanted to look at any other thing, you could just go to Options Hacker and build it there. But if you don't mind, if you see stock and options, then you can always just use Stock Hacker. The scan is very simple. We want to load an options filter, set it to gamma. I load another option filter and I set it to normally 3 days. I bumped it up to 10 earlier, just looking around. So that on Wednesday or Thursday morning, you start to see these higher values. And now that the Qs have 3 expirations in a week, yes, we can see that those are in here, right? So we can go and look at the Qs. I'm so happy that the Qs got 3 expirations in a week, guys. I waited for that for 2 years. Been waiting for that. They kept promising and they kept promising, and it was like, well, you gotta buy me dinner if you're gonna lick my ear like that, because promises. So the gamma, we're hunting for a gamma value in here, and it says we got it in the Qs. Let's go to the risk profile. No, not the risk profile. Let's go back to the scan and find that Q. It would be June 21, tomorrow. That's the one we're looking at. The call side, 348. Really way out there? Right there. I don't see it. It's a 13 gamma. That's not what we want. It's supposed to be a $3 gamma. So as usual, Thinkorswim, getting it all jacked up. It's out of control. The 348 call for the June 21. That's what we're looking at. None of those values look right. So the scanner got it wrong. Shoot, I got so excited too. We're still looking at a 13 gamma. And that's not bad. I mean, it's not bad. 13 gamma is okay. Tomorrow is going to be a lot better. And as we get into Friday, it'll still be a little bit better. I don't have a reason why gamma gets really jacked up. I've done a lot of research trying to find that answer, and I just have never found it. We know what it looks like when it is jacked up, but we don't know. I don't know why it gets that way, right? So TEC is another name on this list. I mean, it doesn't have options. What are you right there? TECS. I got to get the S on there. The technology ETF. It has a gamma of 100 or $1. Read it how you want to read it. That's a very, very high gamma. We've got an expected move of 36 cents in the next 3 days. And if we were to move 50 cents, we would get the entire $1 applied to our strike price shift differential. Honestly, though, it only looks like we're going to get half of it in the first move, and then we would get the other half of it in the other move. And if you've watched the videos on the Greeks, the first shift, the first strike price shift loads the gamma, and then in the next shift, it applies the gamma, right? So this $1 gamma would finally be applied when we get up to the $1 move, because we would have changed through the 50-cent strike and then into the next 50-cent strike before you get it, right? It has to be primed by the delta. I know that probably sounds very confusing if you haven't gone through any of the material on the Greeks yet, but don't let the Greeks confuse you. We actually don't go in and run formulas on the Greeks. We more use them for an evaluation tool. Think of a tape measure. You measure something, you get a number, and you know what that number is, right? And it's the same thing with the Greeks. We want to measure something, not trying to run a constant formula to see what the number is going to be next. We want to look at that number and know what is my delta value, what is my gamma value, not what's my delta value going to be next after this gamma is applied. That'll just run you down a rabbit hole. In a trade like this, though, what I would typically do is on Thursday morning, if I found something like this and I wanted to trade it, is that I would pick one side or the other, and I honestly don't care which side. Maybe you apply some theory or logic behind which direction you think it's going to go, or that it has the highest probability of moving, and then you just buy that option. If you're wrong, you're going to lose whatever the mark was, right? $7. Okay, I don't like to lose $7, but whatever. So you buy that option for $7. If it makes a 50-cent move, you're going to get paid really well because it has a really high gamma and it doesn't make much of a move before it starts to make money. As opposed to looking at something like SPY, which has a really low gamma. And if I was to buy this option and we make, a $1 move, I'm not going to get much in that $1 move. All right? It will make its money, but gamma is how we try to make that determination of when I buy this option, how much is it going to be worth in a $1 move? And could I trade something else instead? Well, if we're going to day trade, this would be why we wouldn't want to go 14 days out for a day trade. It's got an even much lower gamma out here, right? So if I'm only day trading the option, this is a really bad idea. This has a higher gamma. It's got almost an equal delta. So this one is going to make me more money, especially if I think we're going to make a bigger move in the market. Right? Using gamma trading, from how I look at it, is more of a risk-reward scenario, that you are risking 1 to make 7 or risking 1 to make 8, and you didn't need a stop and you didn't need to develop some calculation of risk and worry about support and resistance or anything like that. That when you're going to trade gamma, you can focus on a market that just has a real high gamma value and a really cheap option, and you buy the darn thing. Now, which one you buy, the call or the put, would be better served by focusing on the chart at that point, right? It makes sense. We focus on the chart, we make a determination that we think it's going to go up from here or down from here, and we want it first thing in the morning or the night before, right? That way you are in it for the meat of the move. Because it's a gamma trade, most of the time it's going to be on cheap products. Notice the things that were showing up in that scan: GNW, TECS. When you go to run this later in the week, you're going to get InBev and JCPenney's, if those are still popping up. I'm not sure that they will. You're going to get a lot of very cheap companies with junk options. But those cheap companies with junk options that have a $3 gamma, maybe you're wrong 6, 7, 8 times in a row and you just don't make any money. And then that one time that you do, you covered all of those losses plus some, and you got a really nice payout. So target your trade based on something that you have on the chart and the fact that it has a high gamma, and your day trades will do a lot better, which is why I brought it up in this. Any questions on what we covered here today? And I'll kill the recording after this, but I don't not necessarily going anywhere if there's questions that go to something else that we didn't cover. That way the recording doesn't get too big. All right, no questions on what we covered. I will kill the recording.